Schwab Advisor Services is a proud supporter of the RIA Edge Podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.
Hi, everyone, and welcome to the RIA Edge Podcast. This is, as you know, my chance to speak to the executives who are leading growth-minded RIAs to get a sense of how they're making the decisions they make, where their priorities lie, and the strategies they are employing to make it all happen. Today, I'm thrilled to speak to John Bunch, who is the relatively new Chief Executive Officer of $30 billion Allworth Financial. Folks who've been around the industry for a while know that Allworth Financial, as the firm that was started by Scott Hansen and Pat McLean back in 1993, but now, under John's leadership, they have grown to be a $30 billion plus RIA with a robust acquisition pipeline and a growing national footprint. To me, it's a case study in how the successful transition of a business from a founder-led practice to a professionally managed organization, and all credit to Hansen and McLean for having the insight to recognize the need for having a dedicated management team to continue that growth for the benefit of all the stakeholders. We talked a little bit about how John approaches management, the acquisition pipeline, where he sees the firm going, and in particular, his faith in the future of AI as the answer to that elusive goal for all large RIAs. That is how you keep a personalized service inside of a multi-billion-dollar financial services firm with 500 plus employees. I enjoyed the conversation, and I think you will too. I should note that John and I were both speaking from remote locations, so forgive some audio interruption. But with that, here's my conversation with John Bunch. John, thank you very much for joining us on the RIA podcast.
Yeah, really excited to be here, David.
It's great. I know that my colleague Diana Britton recently wrote a story on one of the acquisitions that Allworth has made. And so I want to get into some of the details of that. But first, if you could just maybe give us, for the folks who maybe aren't as familiar with Allworth Financial, formerly known as Hansen and McLean, if you could give us just a background on the firm and maybe a little bit of a background on how you came to be involved and get into your position as the Chief Executive Officer there.
Sure, happy to. So listen, I've been really lucky in my career, David. I've worked for some of the iconic kind of industry pioneers, whether it was Adam Bold at the mutual fund store, Rick Edelman with Edelman Financial Engines, and now with Scott Hansen and Pat McLean, who really founded the firm 30 plus years ago, broke away from the insurance industry, and really were pioneers on kind of really marketing as you see it today. And so a lot of firms over the years have grown, whether it's by referrals or by, what I would call minor marketing. But our firm really was founded on this notion of, we think that we have kind of built the secret sauce to growing a firm through marketing. And so that started 30 plus years ago. I looked this morning, we're at $31.5 billion today. I think when I joined about 18 months ago, we were in the low 20s. So it's definitely working. I would think that Allworth today is really in the third generation of a company. And I think you have that first generation, which you mentioned, which is Hansen McLean, really focused on, a radio show program and marketing to two very specific segments, the utility industry, and it back then was the breakup of the Bells. And the firm then evolved to a first round of private equity, which I would call Allworth 2.0. And that really was kind of the start of building the inorganic machine next to the organic growth machine. And now I think we're in Allworth 3.0, which is refining our target market, which is really the client or family that has between $1 and $10 million. We believe that financial planning is still at the heart of all client relationships. We also believe that investment management has been underutilized through the years, and so we are kind of emphasizing more of our strategic ability to manage assets. And then lastly, we're a big believer that it's not just wealth; it's wealth and taxes and estate planning. And last year we bought 3 accounting firms. We did over 6,000 tax returns last year. So quite an evolution over the last 30 years.
It's an amazing evolution. I have been covering this industry for maybe about 15 years now, and I remember Hansen and McLean when it was not as large of a firm as it is now. It was a regional firm up in the Pacific Northwest, and one of the interesting things about the firm at the time was that they were one of the few that did few of the independent RIAs that did actual marketing, did marketing. And that was unique, and obviously it worked. So they grew successfully. One of the themes that we keep coming to on this podcast is this evolution from practice to professionally managed business.
Yeah.
Could you just maybe reflect on that a little bit in terms of your role there?
This is really my third time kind of in this environment. So, I think the key here is, when I first started in the RIA space, I was the CEO of the mutual fund store, Adam Bold, very much like Scott and Pat, had a radio show. And there gets to a point in a company where all founders take a step back and ask themselves, is their vision executable with frankly their management skills, their passion, and what they bring to the table? And I listened to the show you did with Scott 3 years ago, and I think that it came to a point where Scott and Pat both realized that in order for us to be a 100-year firm, which is our goal, it's a lot different to manage this firm from 10 billion to 31 billion this morning. And so that that transition didn't just start with me. It started kind of in the last 3 or 4 years, where you start to expand your services, you deepen your expertise in things like finance and marketing and kind of the management of your advisor team. And so I was lucky. Back in 2014, Scott and Pat and I almost did a deal and became kind of one company. So I've known them forever. And I actually had spent the last 3 years prior to this in London, and I was coming back. I was going to start my own firm. And I got a call out of the blue from Scott. He happened to be hiking with Chip Rome. And Chip said, "Hey, I heard John was coming back to the States." And about 3 weeks later, we were able to actually put something together where I could be the CEO of Allworth. And frankly, for me, it's about carrying on their vision. It's almost, to me, a fiduciary responsibility to them to deliver what they had started. And so, we've been on this journey for a couple of years under my stewardship. We're coming off of our best year from an inorganic and organic growth perspective. A lot of things are happening in the marketplace. We've rebranded and kind of moved up market. But I was lucky because I also had a really strong foundation of executives at the company. So we've done 43 acquisitions, and I have a key leadership team. Half of my management team actually is from those acquisitions, which really does help diversify the company, keep the culture alive. And Scott and Pat are still quite active, which is something that I always stress when we do founder transitions. You want those founders to be around and feel like they still have a voice in the future of the company.
Yeah, and I don't get the sense that this is at all a problem at Allworth. We used to think about the issue of the founder not being able to let go of the firm. And as much as they'd like to say that they're going to pass on the baton and give up some control, it's always a difficult thing for them to do. You have not found that to be the case there.
No, listen, I couldn't ask for more respectful founders. And also, I keep them involved, right? I meet with them, a couple of times a month about the health of the business. Scott remains on our board. And also I use them as a sounding board, right? I think it would be, pretty ridiculous for me not to use their expertise because they look at the world a bit differently. All founders do, right? And I think that's one of the things I love about following founders is they have that unique ability to see things in the future that most can't. And so, they still do our radio show. They still do our podcast. They're still able to talk to clients. Pat still has a client book. So, while they're involved, I think that, the day-to-day pressure of running the firm has kind of transitioned to my management team.
Yeah, I appreciate that. And can you speak a little bit about, then you talked about the transition or the transformation of the firm, becoming a national firm, maybe going up market a bit in your acquisition strategy. Yeah. We wrote recently about the Chief Brock acquisition. Talk a little bit about how the ambitions for the firm maybe have changed a little bit over the past few years.
Yeah, I would almost look at it this way, which is it's an evolution, not a revolution. And so what we're trying to do is elevate the company and evolve it over time. And so, we still believe that long-term, there's quite a bit of consolidation that will continue to happen in the marketplace. We believe scale matters in this industry. And if you go back, 10 years when we started this acquisition journey, a lot of our acquisition was around founder and founder succession, where advisors, had 300 to 400 million that they needed a safe place to kind of transition their clients. They wanted to become part of a culture that was growing, that their voice would be continued to be heard. And while that's still true today, our inorganic strategy, I think, is much more strategic around not just the physical footprint, but what are the skills and competencies and unique abilities you want to bring in with acquisition. So Sheafbrock is a great example. Their expertise is more around kind of option overlay and investment management. We acquired the McKelvey Group, another $1 billion plus firm last year, much more focused on investments and planning, and Stewart & Patton, which is a West Coast, $1 billion firm, all within kind of my tenure, which are bigger firms that give us more scale, that add, capabilities that maybe we don't have internally. Now, that doesn't mean we won't do succession plannings and what I would call market tuck-ins, but our footprint, 41 locations, is now pretty broad and diverse. For us now, it's about getting scale in markets. And you talked about Sheafbrock. I'm actually sitting in the Sheafbrock office today. And in Indianapolis, over the last 3 years, we've done 3 large or relatively large acquisitions. We're now a major player in the market, which gives me the ability to advertise locally. We sponsor the VIP section at one of the local arenas. We are deeply involved in the community. And so that's how we get scale, is kind of what I would call plant a flag and then build around that flag from a geography perspective. And so we're pretty excited about our current pipeline and what we've done over the last couple of years.
Is it? I imagine it is. This is a fatuous question, I guess, but acquiring a $1 billion plus firm is a little bit different than a market tuck-in, $400 million firm. Describe that a little bit. There probably are not as many available in the marketplace, or are there? And particularly when you're trying to find a specific service offering that you want to incorporate into the larger firm at the $1 billion plus market, it's probably harder to find those, harder to source those. Would that be accurate?
I think you have to have a 2-tiered strategy, David. So, clearly the $1 billion firms, the vast majority of them are banked, whether it's Houlihan or Hugh Partners or the various other bankers that are out there. And then we also have a dedicated infrastructure of 3 people that all they do is call and build relationships with advisors across the country. And so early on in our journey, a lot of our deals are actually self-sourced. That continues today, but you're seeing more and more banker representation, not just in the $1 billion marketplace, but really going all the way down to 300 or 400 million. And I think that's actually a good thing, because I think it helps buyers build what they want out of the future. I think it helps sellers do that. I think it helps buyers actually have a more streamlined process. So while we do both, and really we don't care if it's a banker deal or not, I think you're seeing more and more $1 billion firms. I think our pipeline right now is about 35 billion in assets under management of folks we're talking to. Now, obviously, you don't win all those deals, and everyone kind of gets their fair share. But I think with today's valuations, with the kind of revolution of artificial intelligence heading our way, I think a lot of firms that may have been in that $1 billion to $5 billion range that may have wrote it out are probably looking at alternatives.
Okay. That makes sense. And I appreciate the banker brokered deal place being more robust. What about on the integration side, however? It seems to me that it's more difficult to integrate a $1 billion plus firm than it would be a smaller tuck-in. Is that just an organizational challenge, or how do you approach integration once the deal is struck?
Yeah, it's a great question. Actually, it's probably, from an integration standpoint, it's probably easier to integrate the larger firms because they're at a different cycle of their business maturity. So, they've got probably more robust systems and have a deeper level of staff. But really, the key to integration is quite simple. And I think many, many firms miss this. This is a people business. And if you don't win the hearts and minds of the people that are going to be joining your firm, I don't care how great your playbook is for integration, it will not work. Because you're talking about buying independent businesses that have been run for sometimes 40 or 50 years. And if you don't walk into those offices with humility and really a deep respect for the employee experience, you're not going to be very successful. You'll get things integrated and maybe you'll hit your targets, but you're not going to build a great firm. You're not going to build an employee workforce that actually wants to kind of be part of the Allworth growth journey. And so we spend a large amount of time on the people side. I'm sitting here in Chief Brock today. I visit all of our locations that we're doing integrations and deals on. And we really want to make sure that while clients are, ultimately our responsibility, you have to start with the employees. We've got 10 people that do our integrations inside of Allworth. Everyone gets paid on the success and happiness of the transition. So, we think that bigger deals are probably easier to integrate, but frankly, every deal is different.
Mm-hmm. Yeah, no, for sure. How long do you talk to these firms? How long do they stay in the pipeline before you decide to make the acquisition and do the deal? And what does that look like? What kind of exploration are you doing? How are you finding out whether or not that cultural fit will work, or they're really bringing to the table what you're looking for, or that you'll be a benefit to them?
Yeah. So, I've listened to a lot of your podcasts and other podcasts, and, every acquisition, discussion starts with culture, and, absolutely that's important. But I think it's much broader than culture, right? Or maybe it's how you define culture, because culture can be anything from how you treat your clients to how you treat your associates to a culture of innovation. And so you've got to really take a 360 view here. And the way we do it at Allworth is it starts with me, right? And I usually do the first couple of meetings with founders to get to know them, right? And it may feel like speed dating in some circumstances, but a lot of times, I've been doing this for 36 years. I either know some of these founders or I know people in the industry that know them. And it really is about what are they looking to accomplish for their clients and for themselves and ultimately for their employees. And then does that vision match up with how we want to run Allworth? And so we're an employee-led business. My job is to make sure that we create a culture where employees want to run to work every day, not walk to work. And there are some firms that, frankly, whether it's the employee element or the innovation element, if it doesn't align, it's a small world. So, we either pass or frankly, they choose someone different. But I would say on average, the average kind of first meeting to close is probably in the 6-month range would be, a really good, timeline. We've done them shorter and frankly, we've done them a lot longer.
I know the Lightyear Capital is as one of your backers in the Ontario Teachers Pension Plan. And this, gives you a lot of firepower in the marketplace. Talk to me a little bit about the funding for RIAs now, because it strikes me that the Ontario Teachers Pension Plan is probably a little bit of a different owner than traditional PE owners, right? Do you find a difference there? We've talked a lot about how the mandates of the PE firm and the mandates of the RIA are maybe sometimes at odds. Is this a little bit of a different situation when you have a longer term pension plan as an owner?
I think part of that, David, depends on the experience of the management team, the founders. I've been on both sides of the equation, right? So I started when Charles Schwab was, less than 1,000 people. When I left, we had 21,000 people. I was the president of TD Ameritrade. And Financial Engines, I was a COO. So I've been in the public space. In 2012, I started working in the private equity space in the RIA arena. And, if you ask me which one of those two environments I'd rather participate in, it's probably the private equity side, because I can make longer term bets and I don't have to worry about quarterly earnings. And I think that, having both Lightyear and Ontario at the table is incredibly helpful because, while they're both private equity kind of, businesses, they do have a different perspective. And, the thing about Lightyear, and the reason, frankly, I joined the firm outside of, knowing Scott and Pat, was my respect for Lightyear Capital, right? So they've been in Advisor Group, a number of other financial services businesses, insurance businesses, Wealth Enhancement Group, Cetera, et cetera. They know this space. And so the conversations I have with them are very strategic, and they're really not about what's going to happen over the next 3 to 4 months, but really what are the industry trends and how do we want to capitalize on those? And then the board is aligned, right? And Ontario and Lightyear have both the same kind of end fiduciary goal for their investors. And we have independents on our board. I think when executives or founders have a challenge with private equity, I think that more than likely the core principles or the objectives are just not clear enough. And I've been in multiple situations over the year with private equity, and I found it a very positive experience. But I also know founders who find it quite challenging because once you've sold that firm, you don't have 100% of the vote anymore. And for some founders, that's tough.
Mm-hmm. Mm-hmm. I guess I was wondering if there's a difference between a private equity firm that has maybe a 6, 8 year, 10-year timeline, whatever it might be, and maybe with some options to extend that or move the investment, roll the investment over into a different fund, versus a pension plan, which maybe doesn't have that time commitment. Is that accurate, or do I have that wrong?
Well, I wouldn't say you have it wrong, but I think that whether it's Ontario or any other kind of pension type fund, they are looking for a certain level of return, and they have a timeline in their mind. That doesn't mean Ontario's held investments for a really long time, and they probably also held them from a shorter period of time. It really is about what is the hurdle rate of return you're shooting for, and how long do you think you can maintain that? And so, whether it's Lightyear or Ontario, if we're hitting what their internal return marks are, I would expect they'd want to invest in us for as long as they possibly could, whether it's in their current form or a new fund. I think it's a market where private equity is very active, but I think once you find a winning combination between private equity and the management team and the business model, you want to try to keep those running as long as possible.
Sure. Tell me a little bit about the way you approach management, and maybe more specifically, what is it that you look at to make decisions around growth? I mean, are there certain metrics that you're keeping an eye on? Are there particular indicators that you look at to kind of help plot the future 6 months, 1 year, 2 years? How do you make a decision whether to hire in marketing versus whether to acquire an investment management capability versus more investment in technology? Even with the financial backers, there's limited resources, and part of your job is making the allocation decisions about where those resources go. What do you look at to make those decisions?
Yeah, well, I had a mentor 20 years ago, David, that gave me a statement. I have never forgot it. And it was probably actually closer to 25 years ago. It was, absent of facts, the CEO always wins. And so you have to be a data-based executive if you're going to run a professional company. And so we have scoreboards and scorecards on everything from our financial EBITDA and how we run the business from a finance perspective to how advisors are serving their clients, our operations. And so it's very data-driven, very fact-based. It then becomes, what is the best and highest use of your capital? And when I think of capital, it's just not dollar capital, it's your people. And, I've got a management team that, has a ton of experience. It's split about 50-50, legacy, Hanson McLean, all were 2.0 executives and new executives that we brought on. And, we try to make that decision in a holistic manner, because I think where you can get into a lot of trouble in companies is it's not one decision that actually ends up really sending you off course. It's a series of smaller decisions that you don't see the long-term consequences on. So, we look at things through a financial lens, we look at through a client lens, and then, ultimately I look at it from a shareholder perspective. So if you're newer in an investment in the private equity cycle, you're probably more aggressive. And when you get into the later stages of those investments, you're not as aggressive because the return on capital is just much harder. But again, I think it all starts with math, to be quite honest.
And looking at advisor efficiency, and you mentioned client outcomes. How do you measure client satisfaction or client outcomes, or whether or not the allocations or the appropriations of capital, human resources that you're making are coming back to you in terms of client satisfaction?
Yes. So we run the business, I think quite uniquely in a sense that we have an advisor council that helps us make, the vast majority of our bigger decisions. And it's not your classic 30 years ago advisor council where it's the top revenue or AUM folks in the firm. It's folks from all cycles of life cycles of their advisory career. So newer advisor, mid-career, some of our larger advisors. And so we start there, and it's really about what can we do to serve the client better. So what's getting in your way, whether it's efficiency or you need new technology or you need new products, everything kind of starts in that ecosystem. And then from there, it's about, how much capital do we have to invest, whether, we look at it as a percentage of revenue, how much am I going to spend in marketing, how much am I going to spend in technology, and of those spends, how much of it are you willing to test and learn and be willing to fail and throw it away? And then where do you need kind of core infrastructure? And so, it's a bit of a balancing act, but, everything has to evolve out of the client experience and the advisor experience. If you don't have happy advisors, you're not going to have happy clients. And if you don't have happy clients, you're not going to have happy advisors. So you have to manage those almost as one.
Makes a lot of sense. You mentioned I started the conversation with the acquisition of Sheikh Barak, and that was the service that you felt you needed there, as I understand it, was a sort of a more active investment component, some investment strategies or capabilities that you wanted to bring to the rest of the firm. Can you just briefly talk a little bit about the evolution in your thinking around investment management and investment platforms? It was not too long ago where the notion of active investment was a dirty word, and that was the commoditized part of the business, and there was no reason to focus there. It was all more about the client psychology and hand-holding and whatnot. But it seems that investments are kind of coming back as a differentiator, as a more of a client service that maybe people are starting to pay a little bit more attention to. Speak to me about how you think about the investment portion of what you do.
Yeah, I actually think it's client driven, right? So if you think about the wealth created in the United States over the last 20 years in concentrated positions in the big tech stocks or other stocks, the notion of just being a 60-40 ETF mutual fund advisor, I think limits your prospects of growth. And we're a full integrator. So while we have a broader menu of investment options, it is still run centrally by our Chief Investment Officer, Andy Stout. And we have made a conscious decision that we want to have a menu that's robust enough to handle kind of all stages of wealth, but we also want to contain compliance and get scale around that. And so if you think about today's world, it's really what's happening in the alternative worlds, whether it's private equity, private credit, but even more exciting for me, kind of helping clients, it's about how do you unwind concentrated positions? How do you, we just brought on an estate planning expert that her whole focus is how do you maximize your return and ultimately your estate, not only using kind of the legal structures, but also investments. And we found that incredibly useful, and it's been one of our major growth drivers in the firm. I also think that what's happened in the industry with Smart Asset, the custodial referral programs, is if you don't have a differentiated offering, and it's not just about financial planning, you're really going to have a hard time competing. And so our custodians, both Schwab and Fidelity, great custodians, but they're going to continue to raise up in their game on what they offer clients, and we have to do the same. And I think the big winner in all this is clients. I mean, I think about 30 years ago, if you would have walked into an RIA, you would have gotten a fiduciary level experience. You've got good planning, but I think that experience today and the knowledge, not just Allworth, but the industry brings to the table, is remarkably different.
Yeah, and more, we hear this a lot, personalized, right? Personalization at scale, giving the clients, the individual clients, the tools that they need and the investment options and the strategies and the planning that, is important to them. And to do that across a firm with 500 employees and who knows how many advisors, who knows how many clients, it seems to be a difficult thing to do. How do you think about personalization at scale?
Yeah, it's probably one of the things I think the most about. So my kind of internal message to the team and to folks that I talk to on the mergers and acquisition front is I want to have a boutique feel locally with big company resources behind you. What we don't want to do is kill what's made them special in the marketplace. Now, we want them to operate under the Allworth umbrella. We want them to be part of a team that really is focused on the kind of building Allworth for the future. But we don't want to break the things that have made them, successful locally, right? I've got a firm in upstate New York that, twice a year they rent out the zoo at night and they invite, basically their clients and anyone they want to bring. And, we wanted to continue that tradition, if not accelerate it and make it better. And so there's a couple of ways you can go if you're looking to sell a firm. There's a lot of great firms out there that is, they have a playbook. You're going to run the playbook exactly how they want it. And, you're probably not going to get a lot of wiggle room on either side of that. We have a playbook. We're fully integrated. We have same tech stack, investment options, but we want to give the local employees and leaders a bit of freedom so they can build what they think works best in their community.
You talked about technology too, but before we get there, I did want to talk about, you mentioned estate planning. This notion of RIAs broadening the service options for clients and perhaps, where at one time they would have referred out to an estate attorney, would have referred out to a trust company, would have referred out to maybe a tax preparation tax planner. That all is coming in-house, and you guys are certainly doing that. Do you see that trend being a mandatory for RIAs these days, or can you still operate in a circle of influence, COI kind of environment? What is the benefit? Well, I think I know what the benefit of bringing it all in-house is, but talk to me a little bit about that.
Yeah, well, we do both, right? And you want to keep those local relationships because there's expertise and years of kind of cultural alignment. But, I come back to this is about the client first, right? And, I think about my life. I've got 4 daughters. I'm awfully busy in my job and trying to maintain a great family as well. And so I think the more you can put things all together in a simple format to make it easier for the client to understand where they sit and make better decisions, that's the winning combination. It's why I think you're going to continue to see consolidation, because as more and more firms get to the scale where they can afford to do this and have the money to invest for the technology resources that are going to be the great enablers, I don't know why you wouldn't want to do this. I think where it fails, though, David, is if as a firm, you're arrogant about your own competencies and you really don't build those other relationships with outside experts, because no one is going to be the best in class at everything. I think you have to pick and choose for your target market what you think are the kind of most important things, and frankly, be kind of best in class at execution on those fronts.
So you are bringing estate planning in-house.
Yeah.
And tax planning and tax preparation in-house, which is unusual. Yep. I think not a lot of RIAs bring the tax preparation part in-house.
Yeah.
A lower margin business, a little bit more of a commoditized business. What's next? I mean, what is the kind of the white space in terms of client service that you feel is missing and needs to be filled if you do want to be the full service firm for high net worth, upper high net worth clients? What is the piece that's missing that you might be looking for next?
Well, I think it's just a continued evolution on kind of what the clients are expecting, whether it's, tax planning, tax preparation, investments, financial planning. I think the big tidal wave of change that is heading our way is going to be AI. And you see it in every aspect of your life. But, I can say that, I started in this industry before really the internet had any prevalence. I can remember 35 years ago when, there was a consideration on whether the company Charles Schwab should be named Schwab.com. So I've lived through this. And what I see on the artificial intelligence front, I think is going to dwarf the change that happened with kind of the cell phone, internet, mobile device being brought to our marketplace. And so we're all in. This is probably our number one strategic initiative, which is how do you use kind of today's computing power in order to make a better client experience, a better advisor experience. Everyone talks about efficiency and margin expansion. Mm-hmm. Well, that's important. I'm looking at this as a way to invest more money back into the business using some of the tools that are, in their infancy right now on the AI front.
Yeah, and I was going to ask you about that because I do hear a lot of advisors talk about, this is going to be an efficiency engine. It's also going to be an efficiency engine in terms of it's going to allow the advisor to do more with less in a way, right? Marketing might be more of a AI function, and the advisor won't have to be writing out the long reports anymore. Are there other uses though that are coming down the pike that you're looking at with AI beyond just simply the operational efficiency that would be of interest?
Yeah, so we have over 40 AI type projects in flight right now, and wow. I think that probably the two that you hear a lot about, Jump AI, which is really kind of the note taking, organization of notes, client feedback that happens in client meetings. We were an early adopter of that technology. 85% of our advisors use it. And the key is with anything related to this kind of what I would call, tidal wave of change headed our way, is getting the employees and especially the advisors on side so that they see the benefit in this. Because you can build the greatest, set of tools, but if the advisors don't see it as a value add, nor the clients, you've just basically wasted your money. And so, we've got an AI council that's got both advisors as well as representation across from the business. We have GPT that's been added to all of our employees. They have access to that on an enterprise level. And we've partnered with a company called Stack AI that I think is probably most interesting, which is if you think about today's investment universe, and we were talking about that earlier, it's getting more and more complex. We're using kind of the notion of large language models to help our advisors type in various aspects of a client's portfolio, and it will actually scan the database of investments, et cetera, and start to narrow kind of what the right solutions are. And it will even go as far as, showing you the solutions, showing you training videos on the solutions, giving you other resources. And what that's done from an efficiency standpoint is, I've got 6 people in my investment department. It's actually taken one full body's worth of work out on a weekly basis so that we can actually reinvest that in more research on investments, et cetera. About half of our advisors use it actively. We continue to see that trend go up. But again, we are in the very early innings here. And, I really do believe this is going to be a great catalyst for better client experiences. And I think margins will improve, but, I think most smart CEOs will invest that money back in the business to continue to grow assets under management.
Yeah, no, that makes a lot of sense. And we talk about efficiency at scale. I think you just laid out a kind of a sketch of efficiency at scale right there using Stack AI.
Yeah. And listen, what's really fascinating, David, is our employees are really leading the charge here. So whether they're in finance or even, HR, number of other functions, by giving them the desktop tools and giving them some education and really asking them, how do you make your life better? How do you make the processes in which you do better? Most of the great innovation we're seeing is coming from within. Now, we want to sprinkle that with some outside resources and really a broader perspective. But boy, if I look at where we sit today versus a year ago and the employee engagement around automation and just process improvement, it's really been a remarkable journey for the firm.
Yeah, it's exciting stuff, and I agree. It's early on. There are maybe with Stack AI and some other tools, there are parts of the business and parts of what your advisors do that are touching the clients that are AI driven. Yes.
Yeah.
It's fascinating stuff. One more quick question on management style, if I could. You mentioned a few times the committees that you have of advisors or AI committee, committee, made up of some of the acquired firms. How do you approach management this way? I mean, it sounds like you have a very much a ground up kind of listening, right, to the employees. And how many committees are there, and how do you juggle the committees, and just give me a sense of your management style and organizational structure.
Yeah. So listen, I was lucky to grow up in the early stages of Charles Schwab and watched how Chuck Schwab ran that company, which is really the foundation of how I try to run the company today. I work for Fred Tomczyk at Ameritrade, another great CEO in our industry, Joe Moglia. I'll just tell you what I did when I came here. I spent the first 90 days talking to every single employee, whether it's one-to-one or in small groups. And I wanted to hear what was on their mind. And frankly, I didn't want to hear about the great things that we did at Allworth. I wanted to hear about the things that were their irritants. And I think if you lead from that position as an executive, and you really do believe you are a servant to those that are inside the firm, you will get buy-in even when it's tough, when times get tough in a firm. And so, I've been through every market cycle you can think of. And, I can tell you the firms that really have a partnership with their employees and it feels like everyone's in it together are the ones that are going to win. I am actually not a committee guy. We only have two real committees. We have the advisor committee and we have the AI committee. I like to run a flat organization. I'm not a huge fan of hierarchy. If anyone wants to talk to anyone, they should feel free to pick up the phone and not feel intimidated. And, I hire great people and I let them do their jobs. I've been doing this a long time. I think I can add value to my executive team. But if I have to make every decision in the company, or a small handful of us do, we don't have a long-term scalable business. And that's why I think, half of the executives come from acquisitions. If you've run your own business and you've been a CEO, we would be silly not to use that experience inside the company. And so you've got to, as a company grows, you got to bring in new resources and new talent. But we're quite active on that front. And, I think, we have a really diverse both thought process as well as just general diversity on a management team level.
Well, that's great. John, this has been a fantastic conversation. I could keep asking you questions, but I feel like I've used up too much of your time here, more than I've scheduled for. So I apologize for that. But thank you very much for the time. Great insight into Allworth Financial and what you guys are doing. And I expect there's going to be a lot more announcements coming up in the future, and we'll be keeping an eye on them.
Well, thanks for having me, David. Happy to come back at any time. But best of luck. Take care.
Yeah, I would love that. Thank you very much. And thank you for listening to the RIA Edge Podcast.
Schwab Advisor Services is a proud supporter of the RIA Edge Podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.